Hi scholars, let's look at TEK 4.10e. It says I can describe the basic purpose of financial institutions, including keeping money safe, borrowing money, and lending. So I'm going to first describe a financial institution, tell you what it does, and give you examples and tell you which one it does, if it's keeping money safe, borrowing money, or lending. And then that's basically it. So let's get started. Okay, so what is a financial institution? A financial institution is places that provide financial services for its clients. Financial means money. So anything that takes in money, gives out money, obviously for a purpose, not just giving it out for free. Depositing money, keeping it safe, borrowing it, lending it, any of those things, it is a financial institution. So here are some examples. We have the bank, we have insurance companies, and mortgage loan companies. Now there's more than that. There's credit unions, there's also investment banks and things like that. But we're just going to talk about these three today. So let's talk about banks first. Okay, so a bank basically has two main purposes. You can put money in the bank that you earned or, whatever, or you can take it out from your account. There is a deposit slip. This is what you use when you want to deposit money into your account. And so it can be through cash or check. So that goes in there, and that's kind of like saying keeping money safe. There's also safety deposit boxes. People put jewelry and other, important things. Money is safe because we are insured through that process. The government says that even if the bank goes bankrupt, there is a safety net through that process. And so it doesn't matter. Our money is safe because of that. And then there's also withdrawals. That's where you take money out of the bank. Okay, so now let's talk about insurance companies. There are many different kinds. First one that I'm going to talk about is auto insurance. Auto insurance is basically anything that drives, and if anything happens, your insurance company will pay for it if it's covered under their claim. There's also house insurance, home insurance if anything happens. There's also health insurance in case you get sick. And then there's also dental insurance. There's also vision insurance, there's also flood insurance and things like that. So anytime something bad happens, the first question is always asked, so let's just talk about how does insurance work. So basically every month you pay a fixed amount. It depends on your insurance company, of course. Like if you feel like you're more prone to getting sick or having dental problems, or you have a very strong chance of getting into accidents all the time maybe, or your house is old, or whatever the case, you probably will end up putting more money every month because most likely something's going to happen, and you want to feel safe that if something does happen, your insurance will cover it. So let me just give you a very, very basic outline of what happens. So every month you pay a fixed amount, a fixed expense, which means the amount never changes unless something happens, but it also depends if it's home insurance, auto insurance, dental insurance, things like that. So January 2016, you put in $100, you pay the insurance company. February 2016, you pay $100. March 2016, you pay $100. April 2016, you get into a car wreck. Because you're insured, your insurance will pay for the car wreck. So that doesn't mean like, oh, you've put in $300, we'll only pay up to $300. It all depends on the insurance company and what their policies are. But basically, let's say the cost to fix it is $3,000 or whatever. Your insurance company should pay for it if it falls under their policy. But then you got to be careful because if you get into a car wreck and it's your fault, then starting May 2016, it won't be $100, it'll be more, because then they're thinking, you're liable to get into an accident. So be careful about that, So now let's say you don't have car insurance, which you're supposed to by law, but I'm just going to give an example, maybe not auto insurance, maybe no dental insurance or whatever. So $0, $0, $0. If something happens, you have to pay out of your pocket. So, let's not talk about car insurance. Let's just talk about dental insurance. Let's say that you have dental insurance and you pay $100, $100, $100. April 2016, you get a cavity. If it's covered under your insurance, they'll pay for it. If not, then you have to pay for it. Usually, dental insurance, your 2 trips to the dentist every year, preventive care is covered. Maybe any extra dental visits just to like check up on things is covered. It just all depends on your insurance policy. So when I got hired as a teacher, we had like 4 or 5 options for insurance. So basically, if, we paid $10 a month, or not $10 a month, like $100 a month, these were the things that could get covered if something happened. But if I paid $200 a month, more things could get covered. So like in the $100 category, let's just say if I had a cavity or a root canal, my insurance would cover it, or they would pay 25% of that cost. But let's say if I'm paying $200 a month, I'm like on plan 2. If I get a cavity or a root canal or something like that, my insurance might pay 50% of that, and I have to pay the other 50%. If I'm paying $300 and something happens, my insurance might pay 75%, and I only have to pay 25%. So it just kind of depends on the amount. But let's say you don't have dental insurance, you're not paying anything. Yeah, you're saving money as far as not having to give up any money, but if something happens, you have to pay for it. So insurance is kind of like a safety net. I kind of think of it as reassurance. Insurance is kind of like reassurance. Reassurance means you feel good, you feel safe. And so, when you're paying insurance, if something happens, you have something safe to fall back on. If you don't have insurance and something happens, you don't have anything to fall back on. Now, like I said, all insurance companies have different policies, it's a lot of research you got to look into, but this is kind of like the basic on how insurance works. And let's say the whole year, you don't use nothing ever happens, or you don't get sick, or you don't go, you don't have any serious medical issues or dental issues, and you don't get into car accidents, and your house is safe. You don't get this money back. That stays with the insurance company. But there are some incentives. Like I know with auto insurance, if you don't get into an accident the whole year, the next year your monthly cost will be a little bit less. And like a year later, it might be even more less. And then I know depending on your age and whether you're married or other like student discount or teachers or something like that, there are some incentives and perks. So that's basically how insurance works. Okay, let's talk about mortgage companies. That was one of the examples on the financial institution. Mortgage companies are known for letting you borrow money, or they are lending money to you. So a mortgage company, let's go through a scenario where you want to buy a house, but you can't pay $400,000 for the house. Okay, so what you have to do is you apply for a loan through the mortgage company or sometimes through the bank. A loan is money that doesn't belong to you that you can use. So they look at your credit score, and if your credit score is good, you're approved. Now, what is credit score? Credit score is like your history of money that you make and any payments that you've made, and it keeps a record of whether you've been making your payments on time or not, and if you haven't been making them on time, how late was it, and things like that. So if you have a good record and it seems trustworthy, they will be okay with loaning you money because they're trusting you to pay them back. Okay? But if your credit score is not that great, they might deny loaning you money because they are afraid that maybe you won't be able to pay them back. If they're going to loan you money and you're not able to pay them back, then they're gonna lose money out on that. So they're taking a risk when they give out a loan to you. So once you're approved, the mortgage company will ask for a down payment. A down payment is a part of the cost of the house. So if the house is $400,000, the mortgage company might say, okay, you need to pay $80,000 for that house. So if you pay that, the mortgage company will pay the rest, which will be $320,000. So your down payment plus the mortgage company like pitching in $320,000, that will pay for your house. Okay? So now your house is bought. Let's say KB Homes or Grand Homes or, whoever owned that house, they got paid their money. So mortgage company paid for the rest. So now the mortgage company technically owns your house. Now you have to pay the mortgage company. So every month you're going to pay a fixed price for an X number of years or an X number of months. And you will also pay interest with it. Interest is extra money, like a cost for borrowing money. Because here's the thing. You borrowed $320,000 from the mortgage company to pay for your house. You can't pay back $320,000. You have to pay back, I'm just throwing a number out there, $450,000, because that's how mortgage companies make money and that's how banks make money. I mean, if we all loaned everybody money and they paid us exactly that amount, like that's what the mortgage company would say, they wouldn't make any money. They're just getting exactly that money back. So they have to charge interest along with your monthly payments. So, some people like to just buy the house for the price that it is and not go through these kind of routes. Like sometimes with cars, people just save up and buy the car. They don't want to do payments and end up paying more for the car. So some people like to buy things in cash, but generally this is how a mortgage company and a loan process works. So it's known for borrowing and lending. It's a financial institution that allows borrowing money and lending money. And then banks are for you to keep your money safe. And then obviously they let you borrow and lend money also if they're kind of tied into the mortgage loan company. So I'm going to explain this one more time in a much simpler flowchart. And then that's it. So let me go over it again, much, much simpler. You want to buy a house. You apply for a loan. You get approved because your credit score is good. The mortgage company asks for a down payment, and then they pay the rest for the house. So now you have to pay the mortgage company. The mortgage company paid for your house to KB Homes or Graham Homes or Grand Homes or whatever, whoever the house was made by. So now you owe the mortgage company money. Like you took out a loan to pay for that house that was paid through the mortgage company, so now you owe the mortgage company. And so you have to pay the mortgage company every month a fixed amount plus interest. Interest is additional money you pay because you borrowed money. I explained that, not everyone can just borrow money and pay back the same amount. Interest gets charged on that through when you take out loans. So let's say it took you 10 years to pay off all that money. So then it's considered the house is paid off or the car is paid off or, whatever.